We've got markets at all-time highs, gold at all-time highs, silver 14-year highs, real estate all-time highs. But as of today, the government is shut down. We do see some cracks, but is it enough to stop this bull? Lots to talk about. Sit back, relax, and let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. We have a registered investment advisory firm, meaning we do act as a fiduciary. So, in the lineup there, I talked about markets at all-time highs, gold, silver, etc. But there are some cracks out there. Is it enough to stop this bull? We're going to discuss that and more during this video, so please do consider subscribing. Now, first up, I do want you to understand we are going to focus on the markets today, but we are a full-service firm, financial planning, tax planning, legacy planning, etc. Now, next up, let's talk about our process, which I have not done a video in a while, has changed quite a bit. In the beginning here, we talk about macro, big part of my process before. Yes, we still follow it, but not the overall driver. We've got fundamentals, not really a fundamental guy. I do look at them. Then we have options flow, representing 50% of the business right now as far as activity in the markets. Need to be aware of that. And last, most importantly, is technicals charts, because this market, as we know, is momentum driven. So let's get to the macro backdrop first. One thing I focus on is market cycles, growth, inflation, policy. Where are we today? We are in cycle 2. Growth accelerates. They are running it hot here. We're going to discuss that. Inflation accelerates, right? And then you've got the Fed, which is a little bit hawkish. Not really, though, in this case. A little bit more dovish with some of these cuts. So let's get into that and why we feel we're there. First up, the growth picture. We track over 25 on both growth and inflation, but big picture, GDP, final revision Q2, 3.8%. Like I said, they're going to run it hot. And our most recent GDP now, same thing, 3.9%. Not the final print, but it has continually gone up this quarter. So next up, let's look at the inflation picture. We've talked about CPI quite a bit. It is rising. The Fed's favorite gauge is PCE. If you zoom in, you can see again, we are rising as well. Right now, we feel the Fed, forget about that 2% target, 3% is the new norm. And that 3%, as a reminder, is rate of change. That is not inflation. We all know we're paying a lot more than 3%. That is the rate of change as we go forward. So then we look at policy, what's going on out there, right? Inflation remains elevated. That won't keep the Fed from cutting rates, despite what I think is a pretty decent unemployment at 4.2%. Yes, inflation should be the biggest reason. They are still going to cut. Believe it's a policy mistake. Right now, this is showing odds in October. We're over 86%. December, we're in the 75% range. They are going to cut, and again, it's going to continue to keep things hot. So next up, we talked about the options flow and what exactly is going on. Not going to get too deep in this picture, but really to keep it simple, negative gamma, positive gamma. Right now, we're positive gamma. When we're in positive gamma, we will generally see more buying as long as that volatility index, overall volatility, does stay a little bit low. Now, there's a couple different parts of the machine here, right? Because there's no fundamentals here. There's no emotions. The machine is doing the buying. One, we have volatility control funds. They're at their 98th percentile, fully allocated right now. We have CTAs, pretty much the same thing. They are fully allocated. So unless we see a spike higher, which would drive some sales, or a spike lower, which could potentially drive and buy more, this should not have much of a change. So Next up, let's get to those technicals. So we like to start out on the longer term, which is going to be the 3-year or less, okay? So we're going to take a look at the monthly view. Here you see the channel from 2009, obviously very strong. This is clearly still a bull market, and in fact, up top here, might be tough to see, we did break above that channel, okay, in September. Now, I'm going to look for a confirmation, see if we hold above that in October. We are seeing some overbought conditions on RSI on this chart, but right now, still very bullish. Now, from there, we're going to go to the weekly, okay? So we go 3 weeks, 3 months, 3 years. Here is our 3 weeks to weekly. Pretty much the same picture, right? No question about what's going on here. Still very much in an uptrend. Down here is momentum is kind of leveled off, but not seeing any sell signals on that weekly chart. Do I see anything? Maybe up here, relative strength was really strong when we hit highs back in 24, and it's gone lower, okay? That's called negative divergence. That's maybe the only thing I see here from a negative standpoint, but no doubt, again, still in a bullish uptrend. Now, on the shorter end, we're going to look at the daily. This is where I'm going to enter, whether it's the S&P or individual stocks or ETFs. What are we seeing, right? Really the same exact thing. Nothing has changed from our April lows. We continue to go higher. What is key here? Might be tough to see, but over here is going to be your 20-day moving average. As long as we stay above that over the short term, we're in a short-term bullish uptrend. We are holding it right now. Then below that, you have the 50-day, okay, which will act as support. Is there anything else we see here? Yeah, right here, okay? On momentum, MACD, we have gotten a short-term sell signal on the S&P. Let's see where it leads us. You can also see this line has been pretty straight here. Actually, it's gone down a little bit, saying that the momentum's been okay during this run, not exactly particularly strong. Anything else that we see? Volatility somewhat tamed in that 15 to 20 range. Unless we get above that, we are not overly concerned big picture. So next, as we wrap this up, just show the cues. Pretty much the same picture above the 20-day, 50-day support. When we build our models, this is our core holdings. Qs is going to be the biggest holding, then SPYs, S&P 500, then the Dow. Okay, then we have a large cap growth fund that has a little bit, only 3% in the Mag 7. So same thing here. You see momentum has kind of stalled out a little bit, just going sideways, but clearly still in an uptrend. Next up, sector spotlight. Okay, first up, going to show a couple charts that are more indicators for me. The first one is going to be the 10-year Treasury, which obviously we do watch quite a bit. Interesting, we actually broke below 4%, albeit just for about 15, 20 minutes. Then we had the Fed announce that they were cutting, and immediately has gone back up. We are coming down a little bit today. Not surprising with the government shutdown in effect last night. I think big picture at this point, we've talked about this, our clients know this. We have really been out of duration bonds, ultra short, 1 year or less, sure, some cash positions, but have not really been in bonds, have not been very effective over the last 4 years. But if it breaks 4% and continues, and we get those signals, we might jump back in. Next up, US dollar. Why is this important? You get the dollar right, you get a lot of things right. Now, today, again, not surprising with government shutdown. It has gone negative today. Also, you can see the trend line, which is to the downside. Why is that important? Well, it's negatively correlated to gold, to the markets, okay? So we really watch a dollar to see what's going on. Also, the effect of the international and emerging markets as well. But the US dollar has been really weak, and we anticipate that to even go lower. So next up, to point out a couple charts here. What's the big picture this year? Metals. Okay, so gold. Okay, We look at gold as a currency, so we will have a bigger position because there's not as much volatility. But a couple things, right? This has been a monster move this year, right? Gold is now up over 40% year to date, obviously outperforming the markets, Bitcoin, etc. What do we see here? Clearly overbought, okay? If you're not in gold, this is not the time to get in gold, okay? We've been holding true. We have not trimmed gold at this point, despite the run up, okay? One of the reasons down here in momentum, we're not really seeing any sell signals in between what's going on with the deficit continuing to grow, this government shutdown, okay? We continue to see gold go higher, which is why at this point we have not trimmed it. Now, next up, same thing. We're going to take a look at gold miners, okay? Really the same picture. This has actually performed better. You know, we got back into gold miners. Hold on a second here. Got to get my pen working. We got back in gold miners back in the spring, and same thing. Has really taken off. Now, gold miners is an equity, more volatility. Yes, we've had better returns, but because of that, that is a smaller position for us, okay? Next up, another one, silver. Mentioned this in the beginning opening here. Silver has now another one that looks fantastic, okay? Silver is hitting a 14-year high. We're breaking out again today. 2% continues to go stronger. The reality is, relative to the S&P, we could still see this go further, but of course, all of that is to be determined. Now, next up, you know, this part of our portfolio, we have our core. If you're in a 60-40, 40 is in core, and then 20%, although 24 is now in these sectors, okay? I'm not showing you all, can't give away all in this video, okay? But next up, a big story I started talking about a year ago is uranium. When Microsoft made a deal with the state of Pennsylvania to bring 3 Mile Island back on board, we knew something was going on. The AI firms, right? There was such a need for power that they're going to nuclear. And what is that? Uranium. And you can see what's happened here again. It really has had a nice run. Okay, not surprising. We got overbought. We're seeing a little bit of a pullback. We'll see where it goes here. Again, this is an equity. Got to be careful with the overall position. So we do have some other sectors that we look at that we do own. But again, can't give it all away here on this video. So next up, let's take a quick look at the macro backdrop. Gone through, we talk about growth inflation policy, but we do look at the entire macro picture. And I think the one thing we have to beware of is it's not just rainbows and puppy dogs out there, right? There are a lot of cracks beneath the surface. Now, the economy is not the stock market, clearly, because the market has continued to go up. So I just want to point out a couple things that we're looking at, and then we're going to talk about game plans. So first thing is delinquencies on car finance loans are soaring, okay? Next up, this was from the Journal last weekend. Sure, GDP looked great, right? But are we seeing a recession warning, okay? And they talk about the gross output is what they're talking about in this article, the GO, right? Annualized, it's actually coming in pretty weak, the lowest we've seen since 2020. So some other factors that we're looking at. The next thing is construction sector jobs, okay, dropped to 2.2%. That's the lowest since 2015 when we did have a pullback. Most importantly, we haven't seen numbers like this since the great financial crisis of 2008 and during COVID. That construction jobs and also heavy equipment sales, things like that, and jobs in that market as well. So the big story today as I record this is the government shutdown. How is it going to impact the market? We can only look back on past and a history and see how it has reacted. The bottom line is it hasn't reacted at all, okay? This shows going back since 1976. The aggregate, they're bringing it together, really has been a non-factor, down about 0.1%, with being positive, the mean, okay, after the fact several months. If we look at the last couple in 2018, we hit a low of 2.5%, ended up up actually 10%. So don't know, not predicting. We're going to track it. If we feel we need to make changes, then we will. But historically, the government shutdown has not affected the overall market. So signals and game plan as we go into the fourth quarter. Why should we stay bullish? Well, I think the biggest reason is right here. M2 money supply, right? That is the money coming through the system. This is all the printing with all these programs and new bills, and from the last administration, this is what we saw, right? And that drives money supply, liquidity into the system. By the way, direct effect of M2 money supply rising and affecting inflation to the high side. So that's what we're going to get. And when I talk about the administration running it hot, this is part of it, right? The next thing what it does is it creates loose financial conditions. Again, this is what the market likes. So these are positives as we go into the fourth quarter. All these bills that have come through. We also feel some deregulation is going to help stimulate things as well. Then right now, we've got $7.7 trillion in money markets. So on the sidelines, if we start seeing that come into the market, that obviously is going to impact things. Why would it come into the market? One of the money markets that we utilized, it was at 4.15% before the Fed. The next day went to 3.75. We've got 2 more cuts coming. We might be under 3% by the end of the year. Factor in your tax bracket, say if you're getting 3%, take 20% off that, okay? And then look at the inflation picture. You're not making money. So this money has an opportunity to move into the market, and that could help us drive things as well. So wrapping things up, our signals. As of now, across the board, I showed you, everything is positive. We're obviously looking at the government shutdown, how long it's going to last, what the potential impact is. Now, setting up for cycle 2, if inflation is going to rise in cycle 2, we have started adding some commodities into our models. There's a lot of other opportunities as well. Staying fully invested, okay? If we have a dip, a little bit of a dip today with this government situation, look for those opportunities because a lot of, across the board, a lot of our big names are at all-time highs. So we have to be careful. We have to be smart when and where we buy, which is buy on red on a dip, not on green. That's how we do things. So hopefully you enjoyed this. Thanks so much for watching. Michael Loftus for Wealth and Wisdom TV.